all entrepreneurs need somebody who believes in them irrationally, who holds confidence for them when their confidence in themselves flags. And to some degree, we have become that to our entrepreneurs. I talked to our team about this idea that when we partner with entrepreneurs, entrepreneurs are handing us their hopes, dreams, fears, and ambitions. And we need to hold that very precious. That's not something one can take lightly.
Welcome to Money Moves, the show about raising money, making great investments, and building venture scale businesses. I'm Neil Devani, your host and the founder of Necessary Ventures, a firm investing in what the world needs. Each week, we'll talk to folks who have raised anywhere from $10 million up to billions of dollars. We'll learn how they return multiples of 10x to 100x or more to their investors. We dive into their stories, uncovering what worked and what didn't, learning from real experiences to understand the journeys of raising capital and rapidly scaling a business. Money Moves isn't just for those already in the game. It's also for anyone interested in the mechanics of startups and venture capital. Whether you want to raise money, make better investments, or just understand how it all works, Money Moves gives you the insights and advice you need to succeed. So join us each week and hear from those who've been through it all and learn from their journeys. Dan, thanks so much for joining me.
Of course, it's my pleasure.
I'm really excited to talk to you because you've got the founder experience, you've got the founding GP experience as well. And a lot of what we like to talk about is fundraising. So you've had experience doing both, as well as investing and building. So we'll get into those. But why don't we start with your experience as a founder in building Standard Treasury? How did that company come about?
It really goes all the way back to 2007. And in 2007, I met Jeff Lawson, the founder and longtime CEO of Twilio. And he was talking to me about this thing called an API. And I was like, in 2007, like API-driven business models were really new, really bleeding edge technology and business model innovation. And I thought about that conversation for a couple years. And then I knew John and Patrick a little bit, and I saw what they were doing with what we now call Stripe. At that time, it was called /dev/payment, right? Like even before they called it Stripe. And I was like, there's got to be more to API-driven financial infrastructure than just credit card processing. It's not, I mean, Stripe's awesome, don't get me wrong, but it's really focused on credit cards and especially merchant acceptance. That's really its bread and butter. They've expanded obviously since then, but it still remains their core business. And I was like, there's so much more that banks and banking is than just merchant acquiring and merchant acceptance. And so could we go build a business that did many of the other things that banks do, but in this kind of like API first, API focused, developer oriented way?
How much did you guys raise for the company?
Well, we raised a bunch, especially coming out of YC. We raised a big round with Andreessen and Index and of course YC. But then we really were at this place coming into 2015 where we needed to raise like a big quantity of capital, like 50 to 100 million. And that's when actually, of all people, BBVA, the big Spanish bank, approached us about buying us. This must have been in like Thanksgiving, December timeframe of 2014. And then they came and made us a pretty good offer. But we had already done a strategic partnership with SVB. So then we went to SVB and we're like, guys, we're a strategic partner of yours, and are you going to let the Spanish buy us? And of course, Silicon Valley Bank couldn't let the Spaniards buy it. And so that was what ultimately led to selling the company to Silicon Valley Bank.
Was it a challenge to raise the first round? I imagine you guys did YC and then raised venture capital after that.
I mean, it's always hard to raise venture capital, I think as it should be. But we got lucky and I think we came out of YC with a lot of momentum for sure.
I think what YC does for founders is incredible in terms of the support around engineering a great moment for them to fundraise and coaching them up to that process to have real progress of some sort or some sort of measurement of movement and momentum before they start that process.
Can I say, I actually think there are two dimensions to this. I think what PG really, Paul Graham, for your listeners who don't know, when I say PG, I mean Paul Graham, who is the co-founder of YC, along with Jessica and a couple other people. And PG really espouses this kind of ramen profitable, durable business creation ethos. And if you read PG's writings, and any of your listeners, I think, would get a lot out of reading PG's writing, he really espouses that. And I think there's some real wisdom to those lessons. The flip side of that is kind of how YC very effectively weaponizes founders vis-a-vis investors. And I have some probably longer thoughts, which I'm happy to talk about today or another time, and I'm happy to talk to your listeners about it as well. But I think what YC does is it empowers entrepreneurs vis-a-vis investors, and that's great. But what I have observed is that you really need a fair bargain between entrepreneurs and investors, as you need a fair bargain between entrepreneurs and employees, as you need a fair bargain between entrepreneurs and customers. And if any of these kind of bilateral relationships or pairwise relationships is fundamentally unfair, you've kind of set yourself up for possible issues down the road.
How do you determine fairness, or how do you define fairness in this context?
I mean, to me, how you would define fairness is around having aligned and transparent expectations.
Between investors and founders.
Well, between any of these stakeholders. If ultimately one set of stakeholders has deeply misaligned expectations with other stakeholders, there's going to be a sense of impropriety, and that's ultimately going to be a source of instability. And it's definitely something I've learned through my years as an entrepreneur and as an angel investor and now as a venture capitalist. Really, in order for this system to work, people have to have honest, transparent, and aligned expectations. And that ultimately comes back to having a set of relationships based on trust. And I think, unfortunately, I moved out to Silicon Valley in 2007. I would say that broadly speaking, there's been a, a movement towards venture capital being more industrial and more transactional. And that I think diminishes the trust-based nature of venture capital, at least vis-a-vis the ecosystem when I arrived in Silicon Valley.
I think there's a lot of validity to that. I think there's an inherent misalignment of interest between investors and founders. That's inescapable, but you can try different ways to create more alignment, and transparency and alignment in expectations is a great way to overcome some of that inherency.
Yeah, I mean, I think the most overused word in venture capital is alignment because it's a word that is really thrown around by venture capitalists in a very kind of just used in a very generic way. And that's, I think, unfortunate. We actually like to use a different word, which is the word integrity. And so to us at Deciens, integrity means that what you say, what you do, and what you think are one, that there's no daylight between those three. And if you say, do, and think with no daylight between them, then you are in integrity. And if you are in integrity with yourself, your colleagues, your limited partners, your entrepreneurs, and your other stakeholders, then you actually can build something special. But if there's a lack of integrity, ultimately, whatever you're building is being built on a shaky foundation.
I like that definition of integrity. I think it's a good one. I think there's more that you need. It's a necessary but not sufficient condition, in the sense that I can think of a case where a venture firm was very in integrity with wanting to fire the CEO who had built the company and install a CEO. I think that they were very transparent about what they were doing, very clear in their communication, but it was a misaligned situation, in the sense that they didn't have a good person to continue building the company, and were just looking for an exit. And there was another investor on the cap table who philosophically, I think, was more aligned with the founder CEO, but maybe not as high integrity in general. But that seems more like an exception case than the general case.
I actually think you said something before, which is quite profound, but perhaps poorly understood, which is most venture capitalists don't invest their own money. They invest the funds of third parties, what we would call limited partners. And I actually think that limited partners and entrepreneurs have much more in common with each other than either of those groups have in common with general partners or the people who organize venture capital funds. And I think like where those in reality, it takes all three parts of the triad to be in equilibrium with each other to really create durable value for those three audiences and the world. And so you were saying something earlier about the misalignment between entrepreneurs and GPs, venture capitalists. And I completely agree with that. And we've worked very hard at Deciens, and we have like some very tangible things we do, which I'm happy to talk about, to try and ease those misalignments or try and like nudge them into greater alignment.
Yeah, I want to get to that. Before we get to Deciens, let's just wrap up a little on Standard Treasury. So you guys sold the company to SVB. What happened after that? You were there for a little while, I think. Did you end up just kind of building internally for SVB? Were you guys engaging with other banks, or what was the experience like?
Broadly speaking, I would say it was quite a positive experience. The really most tangible thing that came out of the acquisition was the ability for Silicon Valley Bank to power Stripe Atlas. If you're familiar with Stripe's Atlas product,
Yeah, yeah.
for your audience, Atlas was a product for companies that didn't have bank accounts. That like when you signed up at stripe.com, rather than like entering your checking account details, you could just like click a button and say, hey, open me a new bank account. And then it would take you through like a fully digital experience to onboard you to Silicon Valley Bank. And then the funds from your Stripe processing account would be cleared into that. So that was like the most tangible and visible, publicly visible output of the acquisition and the post-merger integration. There were a lot of other things we did, but that was definitely the most visible thing we did for the bank when we were part of it.
At what point did you decide, okay, it's time to move on to the next thing?
I mean, I didn't have the expectation that I would stay at the bank for the rest of my career. I sold the company to SVB when I was 29, and the bank, at least in my recollection, this is now almost a decade ago. I don't think the bank had the expectation that I would stay there for the rest of my career. I think I knew that I wanted to do venture capital. I was very clear on that. And I knew I wanted to do it as an early stage financial services investor. I think I probably even knew that when we had sold the company, like that was what I wanted to do next after. Honestly, Neil, if I could have done that within the bank's platform, that could have been interesting. And SVB Capital, under the leadership of Aaron Gershenberg and subsequently John Chena, is an awesome platform. And I'm very thankful that post the bankruptcy, it has a new home. And I've continued to work with many of the excellent people there. Like I could have like actually seen a universe where I stayed at the bank, but kind of moved into a kind of like venture role. But that didn't happen, obviously. And the bank was extremely supportive of me starting Deciens.
And it's been a good amount of years now that you've been running Deciens.
8 years. 8 years, yeah.
Yeah, so 8 years in, how many funds have you raised?
We've raised three funds and then many co-investment vehicles, what are also generally known as SPVs or single purpose vehicles.
And with the first fund, how did you go about raising that?
By hook or by crook?
Tell me about the process.
I'm an extremely privileged human. I went to an elite university and then I had a very successful career as an entrepreneur. And so I came at raising Fund One with a lot of advantages, and that let me get going. But even with that, it was brutally hard. Even with that, our first fund was $18,825,000, and it took me 3 years to raise that, and I pieced it from 83 different LPs.
Did you at any point consider giving up or not raising it or raising a smaller fund?
Many, many, many times.
What is it that kept you going through the process for the full 3 years?
I mean, there are really two things. One is many, many, many people said no, but none of them could articulate to me a reason why our theory of the world wouldn't work. Nobody could say to me, Dan, your strategy, we had like a strategy document and Like we had a Excel model that validated that, and like we had lots of evidence as to why we thought it would work. Nobody could say why it wouldn't work. They could say why it wouldn't work for them, but nobody could say why, like in our math or our logic, like looking at what we do versus a lot of empirical evidence, that it wouldn't work. So that was one thing.
Was it the sector focus, the thesis, and your experience that was kind of the package that people were not disagreeing with, or was there something else that was in the pitch that people were saying, yeah, okay, this makes sense at least?
I mean, from the very beginning, I believe that venture capitalists are too diversified, or alternatively, they're not concentrated enough. So I've always, since Fund One, Day One, Deal One, run a highly concentrated portfolio with high ownership targets and very few names and a very slow, methodical, research-driven approach to investing.
How do you define concentrated for a sub $20 million fund?
9 names.
Wow, that is concentrated. Okay. By any definition, I would say that's pretty concentrated.
I actually think most of it, and if you go on Deciens.com, and we have an article called Concentrated Conviction that talks in some great length with applicable statistical models that we're happy to share about why the math is very clear that you either should run a highly concentrated book like we do, or a highly diversified book like 200 plus names. But there's actually very little power in going from like 9 to 40, as an example, or 9 to 30, 9 to 25. And there's some real downsides. And I think very few people have a rigorous statistical understanding of what is the opportunity cost of the marginal investment in a fixed size fund.
You've also invested across stages. You're not exclusively focused on seed rounds.
So we only start our engagement at seed. We will invest in the later stages of the companies where we were the seed investor, but we only start working with companies at this kind of like formative stage in their life cycle.
Jumping back to what you mentioned about raising the first fund and the time and the number of people, I think you mentioned it was like 80 plus LPs in Fund One.
83.
How many people did you have to pitch to get to 83, if you recall, roughly?
Something on the order of 1,700.
Wow. Wow.
We had about a 1 in 20 close rate.
If you can recall, or if you measured even beyond that, how many people do you think you had to have outreach with, or emails or intros or whatever that stage of the funnel is above the 1,700? Like just to be an awareness of them or them of you.
Many, like clearly a multiple of that, but I couldn't give you specific, like we don't measure that, so I couldn't tell you with any precision how many more than 1,700, but clearly many more.
Did it get, not just from a numbers perspective, but I'm curious about the numbers, but then also your experience of it with Fund Two? Was it easier? Was it?
Can I tell you what the second reason why I didn't quit?
Yeah, please.
I mean, my wife. So this whole experience of starting Deciens has actually given me a tremendous appreciation for the spouses of entrepreneurs or the partners of entrepreneurs, right? The spouses and partners of entrepreneurs are the unsung heroes of the entrepreneurial journey. They are not on the cap table. They are not in the boardroom. They are not a lot of places, but they are at home picking up the pieces when entrepreneurs come home shattered and a shell of a human.
And it's a roller coaster of emotions, right? Because there are also the up days where you have good news, you have some breakthrough, and then the very next day something goes wrong, even the same day sometimes, and that's a lot to deal with emotionally if you're holding space for your partner, or you're trying to be empathetic with them and they're constantly going through a lot of different things.
110%.
Kudos to her. She it sounds like kept you motivated, kept you convicted in your own belief. Did she like hold confidence for you?
I think this is true of all entrepreneurs. All entrepreneurs need somebody who believes in them irrationally, who holds confidence for them when their confidence in themselves flags. And to some degree, we have become that to our entrepreneurs. I talked to our team about this idea that when we partner with entrepreneurs, entrepreneurs are handing us their hopes, dreams, fears, and ambitions. And we need to hold that very precious. That's not something one can take lightly.
Do you think a VC can really be that person versus like a friend or family member?
I think there's plenty of evidence that they can be.
I think so too. I think there's a lot of cases of them not being that, but the great ones, there are great examples as well of the opposite, of people really doing that well. I think too often we focus on cases where the VCs, like as we started in our conversation, talking about the misalignment or the lack of integrity and these kinds of things, which are very dominant and very present. But there are the cases where the VC is that person, is that supporter, that coach.
What I've come to realize is that for as many, there are seemingly an infinite number of ways to make and or lose money in this business. And so I'm not trying to espouse that other approaches won't work. I just know what works for us. And that comes from this idea that like for us, we are all about making sure that our tactics, our strategy, our tactics, and our people are of tremendous alignment. Like we can't run any other playbook because it wouldn't be true to who we are. And the strategies and tactics that we use are because of the people around the table.
Yeah, that makes sense. Let's jump on to fund two. So you raised a much larger fund two. In what ways was it easier? What ways was it harder?
Oh, well, I mean, I think the number one way that it was easier is we were raising in like a late bull market. And of course, that certainly helped. But I think in some ways, Neil, it's a little bit like I actually think that starting your own venture fund is a little bit like either like opening a restaurant or starting a band, starting some kind of creative act, and maybe writing a novel. I've never written a novel. I've never actually done any of those things, but it comports with my mental model. And part of it is like just in Fund 2, we had a much clearer view on what Deciens is. What do we believe? Like what makes Neil, the world doesn't need more venture capitalists. The world needs more courageous capitalists. And so I'm a strong with Fund 2, and even now with Fund 3, we have a much clearer focus on like why do we exist? What is our raison d'etre? Like why the fuck are we in this goddamn business? And why should LPs trust us and believe in us? Uh, as you probably know, the 55% of venture funds don't return 1x net. 75% of venture, like it takes to get to the 75th percentile to get to 5% net IRR. And the treasury rate is like at like over four, almost four and a quarter today. You have to really believe to do this. You really have to believe in your ability to generate meaningful, consistent, not just outperformance, but outlier performance. And I think in Fund 2, and especially now in Fund 3, we have a much clearer set of answers for ourselves, and then, of course, for the universe.
What are some of those answers? What would you say is the biggest differentiator?
Well, fintech is a relatively crowded space, and there are incredible fintech investors out there. There are actually very few fin-serve venture capital firms that are trying to build the next generation of great financial services. Very few. And very few that will lead rounds for companies really on day zero and be in a position to support them through their life cycle. And in that regard, we're really standing on the shoulders of giants in the financial services category, as much as we pay homage to the great venture capitalists of prior generations.
Is it still the same idea of a concentrated book like you did with Fund 1?
Of course, that has been central to our approach and will remain a hallmark of our strategy.
Did the LP makeup, the types of LPs change from Fund 1 to Fund 2?
Of course, and from Fund 2 to Fund 3. In Fund 1, it was largely high net worth individuals. In Fund 2, we started to build some powerful partnerships with institutions, and we've continued to double down on those partnerships in Fund 3 and continue to build net new partnerships with institutions around the world.
Did you find that your conversion rate or the number of folks you had to speak to went down significantly? I would imagine from Fund 1 to Fund 2.
Well, so the difference is so the conversion rate hasn't changed. It's still about 1 out of 20. But what has changed is the dollar-weighted conversion funnel because institutions can make much larger capital commitments than most individuals.
So it's a fewer number of conversations overall. The conversations are probably more in depth. The diligence process is more complex. Conversion rate roughly the same.
We recently closed an LP, an institutional LP, that took 61 months from first conversation to close.
I'm sure there are longer timelines out there, but I've not heard of one than that. That's quite the lengthy process. And this is what folks talk about a lot in terms of build relationships, get to know people, talk when you're not fundraising. I think that's incontrovertibly true between GPs and LPs. Do you think that's true with founders and GPs? Like, do you believe that founders should spend time meeting with VCs, getting to know them before they're fundraising?
I do. And I think, Neil, really the reason for that, I think there are really two reasons. First is if you have an investor that sucks, it's going to make your life hell. And you can't really know if the investor sucks if you like just meet him for an hour and then they stroke you a term sheet. Like, how the hell do you know, like, if they are great or terrible, right? Like, if you think about it as like a dating process, you just need to date for a while to know if you want to get married. We spend, on average, 8 months meeting with a company. But if you look at it, the time from which we meet a company to stroke a term sheet is about 8 months on average. And that's the only way that entrepreneurs can get to know me and my team. And it's the only way that we can really get to know entrepreneurs and know them. And if you really think we're on like a 12 to 15 year journey together, like you definitely want to take a couple months to get to know each other before you getting to the meat of it.
How do you square that with the YC approach in terms of your experience, I imagine, as a founder, but then also the way that investors behave around demo day and the way those processes typically are run?
Well, it's now 11 years since I did YC. I did YC in the summer of 2013. It's now kind of like late 2024. So I can't speak for exactly how they coach people today. But one thing that I've observed is that all accelerators treat investors as kind of like a commodity in the sense that they, like, broadly speaking, treat it as just like one investor is fungible with another investor because all money is fungible. And while there is a certain truth to the idea that like all dollars will pay for engineers and ads and server space, really what it is all the things that other than the dollars that I think can be the most powerful.
I think there's also a distinction to be made between a lead investor who's pricing around, who's taking a board seat.
Which we do in every single deal. Of the 26 deals we've done, we've led and priced 25 of them.
Yeah. So in those cases, you building that relationship and the founder building a relationship with you is very valuable and is different versus if someone's writing $500,000 check into a safe round before or after demo day. There's not nearly as much of a relationship there, and there may not need to be going forward either. So maybe it's just a different paradigm.
But one of the things I've observed is that both an entrepreneur and the venture capitalist are only as happy as their least happy investor, whether that's, in our case, a limited partner or somebody who's an investor on the cap table of a startup.
That's a good rule. I like that. So from fund 2 to fund 3, what were the biggest changes in terms of the raise?
There haven't been really any substantive changes, in my opinion, in the sense that fund 2 is really, I think, a articulation of what myself and my colleagues hope Deciens looks like for many years to come. Of course, there will be tweaks and modifications and adjustments, of course, but it is like fully baked, so to speak.
For a founder or a GP who's just getting started, an emerging GP, what would be your advice on fundraising, the hard lessons you've learned?
You have to be able to ask a very simple question with a very simple answer. And I'll tell you the question. Why should somebody say yes? And Neil, the truth is, for most limited partners, they have no incentive to say yes. So you have to, like, and this is something I've really come to see. Most limited partners don't manage their own money. They're what you would call agents rather than principals. And if you're an agent, you're rarely compensated for outperformance. you rarely, and because early stage venture capital like takes forever, like 12 to 20 years, it's not as if a decision today is really going to positively impact one's career, right? You'll be like two jobs later before if you know a decision you made today is any good. And so if you're not getting paid, then and you're not it's not going to be like important from like a career perspective, then they have very little incentive to say yes. And so you have to ask that very simple question. What is in it for them to say yes? And if you can't have a really good answer to that, then I would recommend going back to the drawing board.
Would you say something similar for founders raising their first round? Or do you think it's different in the sense that VCs are in a slightly different position when they're allocating capital?
Well, Neil, you and I aren't paid to not allocate capital. I mean, it is our job to put it out the door.
And we have quite a financial incentive to do so and to make a return.
For sure. And so like the incentives are actually and in fact, I'd argue maybe like the incentive is too strong to put it out the door. And also like the faster we put it out the door, the faster we can raise the next fund, which means the faster we can have more fees and so on and so forth. So like I actually think the incentives are very different.
And so for a founder raising that first round, how should they act differently or what should they be thinking about? What's the question they should ask themselves?
Are they building a real business or are they building a venture capital, like a moth to the venture capital flame? Because if you're building a moth to the venture capital flame, then that's really all about like creating like FOMO amongst venture capitalists. If you want to do that, do YC. YC is incredible at getting entrepreneurs to just like tickle the like neurons in a venture capitalist in their reptilian brain to get them to stroke checks. It's incredible. I mean, YC has fundamentally reverse engineered the cognitive patterns of VCs in like very profound ways. But there's no evidence that I have seen which suggests that there is a relationship between how good how hot a seed round is and how good of a company it is. And in fact, I think there would be some evidence that suggests that a hot seed round is a adverse signal.
Anecdotally, without having done any sort of empirical research, anecdotally, I would say that's seems to be true. I do think YC does a great job of building speed and accountability into founding teams, and the idea of weekly cadences and measurement and the experience of getting up in front of your colleagues, your cohort, and talking about what you've done in the past week creates a rhythm and a drumbeat that those founders move faster.
We actually institute a very similar approach at Deciens. We talk to every single one of our companies weekly or bi-weekly, every single one. And just because if all you do is you show up to a quarterly board meeting, you've lost so much resolution.
I think that's very true. I want to give you a chance to brag here. What's been the best investment of your career?
Getting married. The second best is going to University of Chicago. Definitely those are the number one and number two by far.
Those are great ones. How about by a multiple, realized or unrealized?
Until it's realized, it doesn't count.
So any realized ones you want to talk about?
But no, I'm only 8 years into a 15-year game.
Couple more years. We'll have you on for another episode. We'll get into some of those.
I would love that.
What are some common mistakes that you see founders or GPs make when pitching?
We actually tried to ask a very simple question, which is what is a great business? And we've realized that most of the literature around venture capital doesn't have an answer to that question, which is actually like quite surprising. Venture capitalists are notionally in the business of investing in new and novel ideas. So you would think that like in theory, they would have a framework for adjudicating what they think looks great or makes great or what are the necessary conditions for greatness and so on and so forth. And we found very little. And so for us, we've developed a framework. It's on our website. If you go to deciens.com, we have written an article called Decoding Greatness. And we talk about what we observe are the necessary conditions for greatness. And so when we get pitched, that's really what we're looking for. Do we think that this business has what we would call the antecedents of greatness? The necessary, albeit insufficient, conditions to turn into a generation-defining business. And so what mistakes we tend to see are talking about things which aren't related to those ideas. Related would be a lot of jargon. We don't think that there are many new ideas. There are just new solutions to old problems. And you shouldn't need jargon to explain that. I'm not an LP, so I don't know what common mistakes VCs make when pitching LPs. But one thing I would observe is that I think so many venture funds are undifferentiated. I believe, like, if you study evolutionary biology, what you see is that it is outlier organisms that can survive and thrive across different climates and ecosystems. And yet, like, so many venture capital funds seem generic. So maybe what I would say is like in venture capital, differentiation is survival. And so I would just encourage venture capitalists, GPs who are pitching LPs, to really be able to articulate a theory of why they are different and why that difference will lead to outperformance.
Yeah, I think it's really important. I think that's a very common topic today, given the proliferation of seed funds. One thing I've been chewing on as of late is sort of the tension between the need to move fast as a founder and as a VC.
We don't move fast. We move slow.
You're one of the few.
I don't know that there's a virtue to speed.
I think that there are virtues if you are dealing with competitive dynamics.
We don't do competitive financings because we don't want to be in an auction. Being in an auction makes us a commodity, and we just refuse to be treated like that.
I think it's a very contrarian viewpoint. And I don't think I'm not saying it's wrong, but I think that there's a lot of VCs, a lot of GPs who do seek out competitive dynamics, want to win competitive dynamics and use that as their positioning. And for founders, it's less, I think, about winning in a competitive dynamic so much as it is making rapid progress against being default dead, to use the PG term. And that's sort of this one side of the spectrum, which is like why you want or need to move fast. But then the other side is the need to move with intention and to not create false urgency, whether it's with customers, investors, whoever.
I actually think that in this regard, there's a false equivalency between VCs and entrepreneurs. Venture capitalists are actually not very much like entrepreneurs in this regard.
You think venture capitalists should move slow and very thoughtfully?
Well, venture capitalists are in the investment management business. And I think that sometimes they over stylize themselves as being akin to entrepreneurs. When I think in reality, we're much closer to like hedge fund managers. And in particular, without like boring your audience to tears, we're much more like long only public stock pickers. And I would say that like the best long only public stock pickers make like two or three very carefully considered decisions a year. And most of the time, they're just getting ready for when the time is right to make that call.
I'd agree with that. I think it's a good analogy. I know we're coming up on time, so I want to just ask you with a grab bag last questions here. These are the more fun ones. What food would you eat if you could only eat one food for the rest of your life?
Sushi.
Any kind in particular?
Good sushi.
All right. What's the hardest lesson you've had to learn in your career?
Being right is neither necessary nor sufficient.
Can you say more about that?
There are a lot of people who seemingly are wrong and make a lot of money in venture capital. There are a lot of people who are seemingly wrong and can raise very large pools of capital. And so like it's very clear to me that being right is not necessary to have a successful career in venture capital.
And there are people who are right, but they don't make personally a lot off of it.
Or they can't stay in the game for one reason or another.
What's been the best moment of your business life?
We work for one of our LPs is a large public pension plan, and that public pension plan supports firefighters and the widows, widowers, children, and dependents of firefighters. And going to their office and seeing the helmets of fallen firefighters, I don't know if that's the best, but it's the most powerful because it reminds me that we're working for them, for the firefighters and their widows, widowers, children, dependents, and that like in a high like one like mistake venture capital has done is it's made itself too ivory tower. We need their capital and they need our returns. And that's powerful. Like the circularity of the economy is what keeps it possible.
That's very well said. I can imagine it being a very powerful moment as well.
I mean, firefighters die young and of tragic circumstances. And like it's not fucking academic to them. It's a very visceral. And like I know it like to our entrepreneurs, it's not we tell our entrepreneurs this. We have another LP who's a charitable organization that provides free schooling to the kids of veterans that have severe PTSD. And like how much money we make is it just that's about how many kids we can send to school for free. And if we fuck it up, that means kids will lose scholarships, right? It's not like there have to be consequences, and those consequences have to be very fucking real.
I think that that's a very different situation than funds who are maybe just backed by individuals who are writing small personal checks or.
We want it to be consequential. I don't want to live a life where the decisions I make are inconsequential. That's not a good life.
Did you seek out those LPs for that reason?
I think a lot of them sought me out because of how I and we as a firm feel about it. That like we're not, we take this like, you know, this is only the best years of our goddamn lives that we're spending on this, right? Like, and so like, of course it really fucking matters. And I think like taking it seriously is the only way you can take it. And I think we've been blessed to find limited partners that want GPs that take it so seriously, that for whom it weighs heavy on them, and they make very considered decisions, often wrong, but at least they're goddamn thoughtful.
Yeah, it's not just for fun. Okay, we're gonna move to a slightly lighter last question here. Who has helped you most in your career?
I mean, the length of the list of people that have helped me could out the door and around the block. So many people have helped me.
You got to pick just one.
I don't actually want to talk about my venture career, although there have been many, many people. But early in my career, one of my mentors said that the only way to get what you want is to ask for it, that nobody will give it to you if you don't ask for it. And I've always tried to live by that.
Do you think that's the most helpful advice you've received? I would have sworn you were going to say your wife. She's already made multiple appearances in the episode.
I mean, everything good in my life is because of her, and everything bad in my life is because of me. I believe that. She's just incredible. But at some point, your audience will just find it boring if I continue to just like talk about how awesome my wife is.
I've only met her the one time, but she did seem really awesome. So I'm glad that you guys love each other so much, and that she's been able to be that rock for you. And I really appreciate you joining for the show.
Of course, Neil. Thank you very much.
Thanks, Dan. Thanks again for tuning in to this episode of Money Moves. If you learned something new or just loved this episode, click below to subscribe. See you next week.